As I mentioned, tonight is part three of our three-part series. If you missed our first two, our first one was Foundations of Investing in Multifamily Syndication. And the second part was evaluating and vetting the sponsor operator. If you missed either one of those two, they are available on YouTube. You just have to search Break of Day Capital, Foundations of Investing, or Break of Day Capital, Evaluating and Vetting the Sponsor Operator. And they should appear. So far in our webinar series, we've done it two different ways. The first one, the Foundations of Investing in Multifamily Syndication. For that webinar, because we were going over so many new terms, we decided to take questions throughout the webinar. Anytime somebody had a question, we answered them because I wanted to make sure everybody was very comfortable with the new terms and looking at the returns as well, the numbers. However, last week during the evaluation and vetting the sponsor operator, we decided to wait to the very end to take questions. And we're going to do the same with tonight's webinar. We're going to wait to the very end to answer any questions. However, at any point you do have a question, on the bottom of your screen, there is a Q&A box. You can type in your question at any point, and we will get to them at the very end of this webinar, but please write them as they come to your mind. So quick bio about myself. Before I joined Break of Day Capital, I spent over 20 years on Wall Street. What I did there was I was a multifamily. I was institutional sales and sales trader. I covered a lot of the largest and best performing hedge funds and mutual funds. And before that, my last job before joining Break of Day Capital, I was a multifamily realtor in Arizona. I did a lot of deals throughout the states. And what I'm doing tonight, and when I talk to all investors, is what I love most. I really love building relationships, talking to investors, building connections, and helping individuals realize their financial goals through real estate investing. Now, an overview of Break of Day Capital. What do? We acquire underperforming multifamily properties in high growth markets in the Southwest. Once we do that, we implement a strong repositioning strategies, best-in-class asset management, and maximize the values for our shareholders. In 2023, we were recognized by the American Apartment Owners Association as the best real estate syndication company of 2022. That organization has over 140,000 members. Inc. magazine recognized us as the 25th fastest growing real estate company on their 2023 list, and 671st fastest growing private company in the US. And over the last 4 years, we've acquired over 1,600 units and have with $280 million in assets under management. Our sponsor operator CEO, Gary Lipsky, he's written a book called Best in Class, and I highly recommend you check it out. If you go to our webpage, breakofdaycapital.com, you can order the book. It is free. You just have to pay for shipping. And Gary does a weekly podcast. Real Estate Investor Podcast is the name of it. If you go to, if you have an iPhone, under podcast, if you type in Gary Lipsky, it does appear. I've been on the podcast, and actually the podcast that will be released this Friday, I am on it with my colleague, Joe Fang, going over what to look for in a sponsor operator. So tonight's topic, ready to invest, what to expect. Once you've decided to invest in multifamily real estate, you do have the option. You can invest individually, or if you're married, you can invest jointly. Also, if you have an entity like a LLC, a limited partnership, or a trust, you can also invest under the entity. If you have an IRA or Roth IRA, you can use the funds from those to invest in a multifamily syndication. However, 401k funds cannot be used. But if you do have a 401k and you want to use that money, what you can do is roll it over into a self-directed IRA. Not a complicated process. It does take a few weeks, but it can be done. And many of our investors actually have done that. So legal documents. There are a lot of legal documents attached to multifamily. The first one that you'll find, and this is on our webpage, subscription agreements. So what is this? This is a written agreement between a company and an investor to buy shares of a company at agreed upon price. The PPM, the private placement memorandum, this document outlines the terms of security to be offered in a private placement. It's a business plan and just resembles that in content and structure. Now, the OA, the operating agreement, and the LPA, limited partnership agreement, are basically the same thing. However, the operating agreement applies to a syndication, while a limited partnership agreement applies to a fund. So the operating agreement is a document that customizes the terms of a limited liability company according to the needs of its members. It also outlines the financial and functional decision-making in a structured manner. It's similar to articles of incorporation that govern the operations of a corporation. Now, accredited investors. Some deals are 506B, which allow non-accredited investors to invest, and others are 506C that only accredited investors can invest. Our currently offerings are 506C for accredited investors only. Now, what does one have to be considered accredited? There's two different ways. There's the financial criteria that can accomplish that, or professional criteria that it can accomplish that. So the financial criteria, an accredited investor must have a net worth over $1 million, excluding a primary residency. So if your home is worth $2 million and you only have a couple $100,000, let's say $200,000 outside of that, you would not be considered accredited because your primary net you have to exclude your primary residence. However, if you own two homes, and let's say one was worth your primary residency was worth 1.5 million, and your other home was worth 1.2 million, you would be considered accredited. Now, the other financial criteria, this is not you have to have all the above. This is an and/or. You could have either one of these would suffice. The income requirement would be if you have income over $200,000 annually individually, or $300,000 with your spouse, each of the prior 2 years, and reasonably expect the same the current year. Now, there's a professional criteria that you can use to be considered accredited. An investment professional holding the Series 7, 65, or 82 are considered accredited. And another way to be considered accredited is if you're on the general partner's team or an employee of the fund. So, for example, I would be considered accredited because I work with Gary Lipsky, even if I did not have any of the financial criteria or held the Series 7, 65, or 82. Now, going back to what you can expect when you're ready to invest. Now, if you do choose to invest with us, you'll have access to the Secure Investor Portal. Now, what's on the Investor Portal? The first thing is we're going back to the legal documents, the subscription agreements. Your completed subscription agreement will be found on that. And also the accredited investor's letter. Now, that we can provide a template for your CPA or attorney that they can sign off on that you're accredited. And also other people, we can accept tax returns or financial statements that meet the requirements is another way. And there's another way too, you can become accredited online. If you go to, the site is posted there, parallelmarkets.com, you can go on there and fill out the paperwork and get an accredited letter as well. Also on the Secure Investor Portal are your tax documents. For multifamily investments, you get a K1. And also on this page, we upload the financial documents for the property you're invested in on a quarterly basis. So you'll find on that the profit and loss statement, the T12, which is a trailing 12 months profit and loss statement, the rent roll, which is another very important financial documents for multifamily, and other documents as well. Now, if you were on last week's, or if you listened to 2 weeks ago's evaluating and vetting the syndicator operator webinar, we talked about how important transparency is. And with us, if you invest with us, whatever property you're invested in, you will get a monthly newsletter about the property. And below, you'll see what it looks like. So we'll give you the financial results on both a monthly basis and on the ITD, which stands for inception to date. So from the day the property was acquired, these are the financials. We break it down between the actual numbers and pro forma, so what we were anticipating, and the difference as well, the variance, if it's doing better or worse than we expected. And as you can see on this financial results statement, the first line is the rental income. The most important, how much rental income are we acquiring on a monthly basis? The second number is RUBS. And actually on our webinars, we have not, this is actually a term I've not gotten into in any of the previous 2 webinars. Going back to RUBS, what RUBS are, it stands for Ratio Utility Billing Service. If you own a multifamily property, as the owner, you're responsible for paying for water, sewer, and trash pickup. If a property, unless a property is master meter, we have to pay for electricity as well. Our last deal Spanish Trail is not. So those are 3 things that owners are responsible for paying for. To recuperate some of those expenses, when a tenant signs a lease, it'll be the rent. So let's say it's our last deal Spanish Trail, a tenant signs a lease for a 2-bedroom apartment. The rent is $1,300. Often attached to it, you'll see a $50 RUB. So we're charging the tenant an additional $50 to recuperate some of these losses. Very common in multifamily real estate. After RUBS, you'll see other income, and that can be numerous things. It's late fees, pet rentals, charging for covered parking. So the total income, then we're going to take away the operating expenses, and then you get the net operating income, the NOI, the most important line. And we also give you an update about the occupancy, the previous month, the current month, both current occupancy and the pre-lease to show you what it's looking like going forward. Now, when we send these out, we talking about the importance of transparency. If our property is doing worse than expected, we're going to explain to you why. Most of the time, it has to do with occupancy. And let's say an occupancy, dropped down on, unexpectedly 1 month. We're going to tell you what happened and how we're going to remedy the situation. Usually, it means more advertising. Maybe we're going to have, one of the property managers spend more time on the property to be there when people show up to get them to view the properties, whatever it takes. But we're going to give you an explanation of what happened and how we're going to remedy the situation. And likewise, too, if the property is doing better than expected, we're also going to explain to you how is it going and how we're even going to try to improve upon that. So you do get this, monthly update. As I mentioned before, too, the quarterly financial reports will also be updated into the portal for you to take a look at on a quarterly basis. And don't forget, too, availability, accessibility. That's one thing that myself and my colleague Joe Fang, being the investor relations team, pride ourselves on. We are here to answer your questions and to get back to you as soon as possible. So once you've invested with us, we are still here to answer your questions. I personally, when it comes to getting back to investors, my goal is to get back to somebody, hopefully within an hour, but if it's not possible, certainly by the end of the day. I get back to everybody by the end of the day. Now I'm going to go get into tax benefits of multifamily investing. Now, a cost segregation study. You'll often hear this term about, oh, what happened? Did they do a cost segregation study? So what is that? What that is, it's a process where they look at each element of a property. You split them into different categories. It allows you to benefit from an accelerated depreciation timeline for some of the building's components. So you look at things like the roof, the appliances, the flooring, the windows. Now, another question that frequently comes up is bonus appreciation. In our pitch decks, we say how much bonus appreciation the property has. So these are the definitions of the term. So depreciation is the amount that could be deducted from an income each year as appreciable items age. Now, accelerated depreciation is you do a cost segregation analysis. You identify all the property-related costs that can be depreciated in under 20 years, and you speed it up. Now, bonus appreciation, in 2017, it was passed the Tax Cut and Jobs Act. And this allowed businesses to take 100% bonus appreciation on a qualified property. Now, this number is starting to go down. In 2023, the way it was signed, it was going to, starting in 2023, it was going to go down about 20% each year until it hit zero. So in 2023, companies can take 80%. In 2024, the number is currently 60%. But there is hope out there. There is a lot of talk right now in Washington that they may get it back up to 100%. We'll see what happens, but there is definitely hope that could happen this year. Now, bonus appreciation and depreciation in general has huge benefits to the investor. Depreciation in real estate is the #1 way to reduce your personal taxes by sheltering income. For all of us, taxes are our largest expense. We look at our paycheck, we see how much is taken out. But what's great about real estate is the passive losses in the syndication, they pass through to the investor. And what's even better is these passive losses from one asset can actually be used against passive gains from another asset. So what does this look like? So this is the benefit to the investor. Let's say you invest $100,000 into our next deal, and there's 60% bonus appreciation in year one. So on your K1, it'll show a loss of $60,000. And this can offset passive income gains regardless of the source. So you can use this negative $60,000 for other real estate investments to offset some gains there. If you own a K1, if you have business ownership in another business, you can use that as well, where you materially do not participate. And what's also great about bonus appreciation is it carries forward indefinitely and can be used whenever you have passive gains to offset. We're often asked, can you use it to offset, W-2 or 1099 income? And the answer most of the time is no, but there is one exception. And that's if you claim that you are a rep, a real estate professional. If you have that status, bonus appreciation can be used to offset your W-2 or 1099 income. Now, in real estate investing, there's a very popular term or procedure called 1031, and there's another procedure called a lazy 1031. Now, I'm explaining both of those, and also I'm going to get into a little bit why I prefer actually the lazy 1031. So what is a 1031, or often frequently called a 1031 exchange? What a 1031 exchange does, it allows the investor to defer paying income capital gains tax. So once you have a property, let's say you sell it, what you need to do then is you need to find a property of equal or greater value to the one that was being sold. you must identify a property within 45 days. And you usually give them a list of these are the properties I've identified. And once you've done that, you get a property under contract, and it must be purchased within 180 days of the initial date. And what's also important about 1031 exchange is you must use a qualified intermediary to hold the funds. You yourself cannot take the funds and just put them in your bank account. You have to have an intermediary hold on to the funds during the process. So you can do this to avoid paying the capital gains tax. And so what happens if you do this and the replacement property is less than the relinquished property? The difference is called boot. And you do have to pay a capital gains tax on that amount of money. So there's another option, the lazy 1031. So what happens in a lazy 1031 is you've sold a property and you have these gains. Now, as I said before, if you do a 1031 exchange, you have to identify a property or properties within 45 days and then close it within 180 days. In a lazy 1031, you do not have to do that. You do not have to worry about identifying a property and then making sure it closes. And you also do not have to use an intermediary as well. The money can go right into your own your bank account. And the only time requirement is you do have to invest with a new group or real estate investment within the same calendar year. And when you do this, the way you avoid paying the capital gains tax is the bonus depreciation. Now, before I joined Break a Day Capital, as I mentioned, I was a multifamily realtor. And 1031 exchanges can be they can feel rushed. I did help a couple people go through them. And it can be stressful because, again, you have to identify a property and then you have to make sure it closes as well. And you also have to use the intermediary as well. So there's a lot of moving parts to it. Sometimes you can find a property, but many times you cannot find a great property as well. So when it comes to an investor, I talked to a lot of people who've reached out to me and said, well, I'm considering right now selling. I have a second home. I have some condos. I have a fourplex. I have an eightplex. I have some properties I'm looking to sell right now. And they've asked me about 1031. I say to them, well, consider a lazy 1031. A 1031, it's rushed. There's a lot more red tape. Do a lazy 1031. You're going to offset that capital gain through the bonus appreciation. And you're also not going to have to worry about, a time ticking down on you. So, but there is one thing to do remember about bonus appreciation, and with a property, when you do sell and reinvest the funds, that there is recapture. So if you ever do sell if you've put money into a syndicate and taken advantage of the bonus appreciation, if you do, when the property is sold, if you do not continue to reinvest the funds and take your money out, there is a recapture. Typically, it's a maximum of 25% of the bonus appreciation. But most people decide to keep on reinvesting the money that they've earned to avoid paying the capital gains tax. And as I said before, too, what's great about bonus appreciation is it carries forward. So that is the conclusion of my presentation. We are going to open it up to questions. And I also, as I say, I want to remind everybody that if you do want to discuss this in further detail, you have any other specific questions that come to mind after this webinar, feel free to reach out to me. I can be reached via email at adam@breakofdaycapital.com. My number is also on the bottom of every email I send out as well, but I can be reached at 602-529-2056.